Live from New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, new restrictions clouding the outlook, making progress towards substantial progress, and real yields hitting fresh record lows. We begin with the big issue, the recovery, hitting some supply-side headwinds.
It's about workers.
Labor shortages. Work shortages.
It's about inputs.
Higher cost of materials.
Higher input costs.
Inflation on our input costs.
Supply chain bottlenecks.
That affects the whole of supply chain.
On one side, we have this growth of recovery. On the other side, we have the volatility.
The micro indicators are very different from what the macro models are telling you right now.
Most of these bottlenecks will be overcome.
Most of those will and should gradually ease into the end of the year.
If you listen to companies, it's very different.
Of course, there's going to be some hiccups as we restart the economy.
The functioning of the labor market, we don't know enough about. The price-setting behaviors of companies, we don't know enough about.
Joining us now to discuss is BlackRock's Marilyn, JPMorgan's Lisa Coleman, and Ashish Shah of Goldman Sachs Asset Management. Lisa, I want to start with you and talk about Q4 and September going into Q4. A lot of people are waiting for this supply-side response in this economy. How can we have any conviction or confidence about the outlook without seeing that first?
You know, our view is still unchanged. And yes, we've had a little bit of bad news coming through. But, you know, at the end of the day, we think the economy is still on track to recover, notwithstanding that GDP print that we saw. The components that we have, you know, the reopening is still in place. It's going to take some time, but it's happening. The consumer is in great shape. Disposable income from the consumer is very high. Inventories are low. Those are going to get rebuilt. We think we're on track. We'll just continue to see the economy slowly start to come out of this slump.
Marilyn, do you agree?
Yes, I think that we are continuing to see inventories built up from very, very low levels. We are seeing issues in terms of capacity constraints, supply side constraints. Obviously, the labour market is proving challenging in terms of finding actual labour to fill many of the tasks. So I think as we overcome these supply side constraints, and I think as we do continue to see sort of supply chains improve, I think we'll continue to see very strong, robust data, which we are continuing to see, whether you're looking at the labour market, payrolls, economic activity. It is very strong and it's continuing to improve.
Ashish, what's your take on this dilemma?
So I think we're starting to see the early signs of labor easing in the states where benefits have started coming back and where there's strong underlying demand. And so that in our view, bodes well for the fall where some of those constraints are going to be coming off. But I also think that we have to kind of take a step back and say that we've been on this V plus type of trajectory and that we can't legitimately expect that to be kind of the rest of the next year or two, that we're coming out of the V and we're going into more of a normal growth cycle, which I think is going to be constructive for markets and particularly for credit markets.
Well, let's talk about where it might not be as constructive. Or maybe it will be. I've no idea. The Treasury market, literally, Ashish, at the moment, I can't explain any of it. And seemingly Chairman Powell can't either. This is what he had to say. I don't think there's a real consensus on what explains the move between the last meeting and this meeting. Can you explain that move from 150 down to 112.60 last week?
I think it's really easy to explain. I think when you look at not whether growth is good or not, but what's the pace of acceleration of growth, globally, we're seeing a deceleration of that V shape into a normal growth cycle. And so that's the first thing. The second aspect of growth, like Delta variant, is reminding us that this pandemic is not over and that we're going to have varying kind of points of recovery rather than everything going back to normal. And then when you add in the technicals of summer being a shortage period for duration, along with policy stance, which probably is going to opt for taking a little stimulus away so that they can be really slow in taking stimulus away. I think all those things add up for a lower, flatter curve.
123 on 10s on the nominal yield. Lisa, is there a reason we're at negative 117 on a real yield?
You know, honestly, it doesn't make a lot of sense to us. When we think about what's going on, the economy continuing to improve, I think most people are calling for nominal yields to rise. And so when we look at where the real yield is, it just seems too low. And frankly, the only explanation that makes any sense to me, and believe me, I'm not a rates expert, but it just seems as if the weight of cash just continues to hit the market, whether it's in treasuries, whether it's in corporate bonds. I think as long as central banks continue with quantitative easing, just the sheer weight of money is pushing down nominal yields. And this seems to be having an impact on real yields. It's the only explanation I can come up with.
Marilyn, what's your explanation? I hear a lot of observations. A lot of people will come in the morning and they'll tell me, John, look, negative real yields, 120, we're pushing those kind of levels, all-time lows. I'll ask them why. Give me some analysis, and I won't get any. In fact, I might get a little bit. They'll say, look, it's a very illiquid market. The Fed owns a quarter of the TIPS market now. What you're looking at is just driven by technical factors. Don't try and read too much into it. Would you agree?
Well, I think that Lisa made a very good point in that the market is absolutely awash with liquidity. And we didn't hear much out of the Fed this week. We heard that the ECB is really going to stay very loose for even longer than potentially maybe we had previously expected. I think just the huge amount of liquidity, the huge amount of asset purchases that are still being operated by various central banks, I think it continue to weigh on markets. And there's this huge amount of cash sitting in banks, sitting on balance sheets, and it needs to be put somewhere. And basically, I think a lot of investors, a lot of institutions are really just trying to find somewhere to put this cash. And so it's going into treasuries, it's going into the bond market as a whole. And I think that's really what's causing these problems. And that's why we think that, maybe in Jackson Hole and maybe in September, we will start to hear a little bit more from the Fed around the potential for actually starting to taper, because this huge amount of liquidity, we really think now is just really distorting markets.
Are you expecting the same thing, Ashish?
So I kind of take a step back and say we are expecting the same thing. The Fed is looking at the economy and saying, hey, things are a lot better than they were 12 months ago, 18 months ago, when they put in place a lot of these policies. But at the same time, we all have to keep a big eye on the big picture, where there's a lot of people retiring. There are a lot of liability demands. And so the demand for safe yield is unsatiable by this world. And so you're going to continue to face a demand supply imbalance for higher yields. Higher yields are going to be bought by pension funds, they're going to be bought by insurance companies in volumes that are going to be daunt any issuance that we end up seeing in the marketplace. So I think it's a good reminder that when you see these backups in yield, to remember that there's just not enough yield in the market. The problem isn't that there's too much yield in the market.
So my question, Ashish, to you would be, why would I expect yield curves to steepen anytime soon, given everything you've just said? Why would you position for a steeper curve in, say, Europe?
Well, I think reason number one is that everyone's gotten blown out of the steepener. And so now the consensus is this slower growth. And in Europe, if anything, you've seen policy move the opposite direction from an expectations perspective in the US. The US Fed came out and said, hey, we want to withdraw liquidity. In Europe, the ECB came out and said, hey, we want to be more accommodative than you thought we ever could be. And so I think that leads kind of to a relative steepening in Europe relative to the US. And that is a real change in the marketplace from an expectations perspective.
And you've all got some calls when it comes to Europe. Marilyn, I'm looking at one of your calls, long Italian bonds, short German duration. Just walk me through that.
Yeah, so when you look at Italy in particular, we've seen somewhat of a widening in recent weeks. But I think overall, when you look at the ECB really, confirming that they're going to be a massive backstop in terms of buying bonds, in terms of keeping rates low for a very, very long time. We think there's further scope for compression between Italy and between Germany. We also know that Italy is one of the largest beneficiaries of the recovery fund. And then even when you look at the data that we've seen out today in terms of GDP, in terms of economic activity, Italy is actually, accelerating in terms of growth. It's performing much better than expected. And we think that will continue, if you look at the periphery as a whole. So we've seen not just Italy, but also Spain and Portugal in terms of GDP. They improved well above expectations today, and we do think that that will continue. And so overall, I think there is still a decent amount of spread compression that we can see between Italy and also when you look at bunds. I mean, when you look at the very, very negative yield in bunds, we do think that they will drift higher towards the end of the year, notwithstanding the ECB remaining very, very, very loose.
Look, a little bit of optimism around the panel on Europe. And Lisa, you're no stranger to that either. You think that on the European bank side, AT1s, hybrids, the CoCos, just walk me through the thinking there.
Sure. I don't know if today was the best day to do that recommendation, given that we just got the EBA stress test. So, but what I would say is it just confirmed our views on European banks, that they are incredibly resilient. So when we look at what's happened with the banks, they've come through the pandemic really well. The asset quality is good. We're now starting to see actually a release of reserves that were made early in the pandemic. And I think what's really important is the amount of capital that's been built up by these institutions has been incredible. And so when we've gone through this most recent stress test, the results that we got today, we saw a drawdown of about 500 basis points, which, in and of itself might seem very severe. But when we look at the starting point of capital for these banks, and again, this is a very severe stress test, they actually come out pretty well with about 10% capital. So we feel very confident. In addition, because of this excess capital that they have, they're also able to, without any difficulty, pay coupons, which is the holy grail for owning AT1. So we love the European banks. We think it's one of the most attractive investments out there.
Ashish Shah, do you want to weigh in on that trade?
Banks are the new utilities, and you want to own the utility bonds in these super safe banks. Banks are not in the business of taking credit risk anymore. Capital markets are. And so I think it's a equally attractive trade in this credit spread universe. Where there certainly isn't a lot.
Alongside Marilyn Watson and Lisa Coleman, sticking with us. Up next on the programme, the auction block, Apple going back to the well, leading the charge in high-grade debt markets. That conversation up next from New York. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time for the auction block, where we kick things off here in the United States with month-end sales going smoothly at this week's Treasury auctions. Only the 7-year offering seeing a drop in demand. Apple leading the charge in high-grade debt markets. Its $6.5 billion offering helping push weekly sales above forecasts, and high-yield markets coming to life following Chairman Powell's news conference. Weekly sales topping $5 billion, taking July's tally to roughly $29 billion. Back with us is Marilyn Watson, Lisa Coleman and Ashish Shah. Lisa, I want to start with the high-grade market. And you don't have to comment directly on Apple if you don't want to. But for a company with that much cash, to tap the debt markets 4 times since May of last year, what's behind that kind of activity?
Well, without getting into too much detail on Apple, I mean, they have a stated plan of being net cash neutral. And so in connection with that, this is a company that accumulates an awful lot of cash. I want to say it's about $90 billion of free cash flow per year. It makes sense that they're coming to the debt markets to try and achieve that goal. And what I think is interesting about this issue is, good for them. They, at a blended rate, achieve just about 1.5, 1.6% funding. To me, for companies high quality that can borrow at that rates, I say, why not? It's a great opportunity for you.
And they keep saying, why not? Ashish Shah, many others have followed as well. The reason I ask this question is because I'm trying to work out whether we are in this so-called golden era, this golden era for the credit market, whereby the C-suite starts to manage the balance sheet for the debt holder a little bit more than the equity holder. At least that's the general outcome. Is there anything in that? That's how people thought things would play out 12 months ago. Have you seen any of that discipline?
We are seeing that we are what we would describe as mid-cycle. This is probably one of the fastest cycles that we've ever seen, where we went from recession all the way to risk-taking behavior being kind of more normal. And so I would think about the credit markets as a carry trade from here, rather than a way to generate total returns that are quite material. But people are looking for yield. And so credit markets are a fine way to get good, safe yield in your overall portfolio.
Marilyn, your take?
Yeah, I mean, I think certainly the market is very favorable for issuers like Apple But as she says, there's a huge wall of demand from investors looking for carry, looking for yield. And we've seen a huge uptake in the US, in Europe, elsewhere. There's this huge demand, just for yield. So I think for companies that can issue at incredibly favorable rates in this current environment, then that makes total sense. And I think when you look at the earnings, when you look at the forecast going forward, then I think all of this leads, they're continuing to, these companies such as Apple, they're continuing to invest in their business, they're continuing to invest in technology. We're seeing, Amazon, they continue to invest. And I think it makes sense to lock in these low rates and, look forward to the future and continue to invest in their business models.
Lisa Coleman, a lot of people have come on this programme over the last several months and picked out that pocket of double Bs to triple Bs, that line between high yield and investment grade. And they've talked about the upgrade potential of the double Bs and the defensiveness of the triple Bs, those companies that want to hold on to those ratings. Is there some opportunity there still, given I've been hearing about it for so long?
Yeah, I think there's still opportunity there. I mean, look, you look at earnings and the way they're coming out for companies. And I just want to comment on one thing, just on deleveraging before I get into the discussion about double Bs. Some of the work we've been doing, which is showing where revenues are coming in, where EBITDA is coming in, and even under assumptions for some moderate growth in overall debt, U.S. investment grade companies are going to delever whether they want to or not. And that's what I think is the most remarkable thing about this recovery. I mean, we see, between now and the end of the year, according to consensus expectations, about a half a turn to almost a full turn of leverage coming down for the median investment grade company. So I think that's just really powerful. Now, why that's also pertinent to what's going on with some of the rising stars, I mean, there's a whole host of them. And look, without getting into too many specifics, but, well known in the marketplace, Freeport, Ford, Kraft Heinz, Netflix, the list goes on and on. These are all companies that are benefiting from this recovery. And given the way their credit metrics are coming out, within the next 12 to 18 months, we should see a whole slew of these companies move back up into investment grade.
Leverage is coming down. Ashish Shah, what Lisa Coleman just said there, I think is so important. On the equity side of things, this bull market has been so hated for so long. And this credit run that we've started to see develop over the last 12 months, I think is equally hated. The distressed debt guys didn't have their window. It was about this long. It was about 10 minutes. The Fed closed it for them. And since then, spreads this tight are hated. And yet no one really talks, not a lot anyway, about what Lisa just talked about, that the fundamentals of these credits have been getting better and better. And default expectations have been going the other way, not the wrong way. Can you walk me through that from your perspective?
Sure. So I think one of the things that Lisa highlighted is the power of those low yields in the marketplace and how they lead to cash flow generation for any borrower, whether it's corporate, whether it's sovereign, or whether it's a consumer. And so when we think about it, spread product in general is very naturally delevering at normal leverage levels or even higher leverage levels. And so it tells you you're on a strong path of credit improvement with a backdrop that might involve tighter spreads, but improving underlying fundamentals. As a fixed income investor, you love to hear that. And you especially love to hear that with this background noise of we're going from a V of steep growth and the fear of inflation to more moderate positive growth, which is a fantastic environment for fixed income.
I'd like to talk about the risk to sentiment and whether that could come from China. So let's do that next, just to wrap things up. Everyone's going to be sticking with us. Still ahead, the final spread. The week ahead, featuring the payrolls report right here in the United States. That conversation next. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, we get China PMIs this Monday, then an RBA rate decision on Tuesday, followed by the Bank of England on Thursday. Another round of jobless claims coming ahead of the main event on Friday is the payrolls report. Just enough time to get some final thoughts from the panel. Marilyn Watson, Lisa Coleman, Ashish Shah. Marilyn, let's start with you. China. Huge focus on China when it comes to IPOs on the equity side, and not enough on what's happening with Asian credit and how maybe this starts to bleed out. From your perspective, and I'll ask each of you this question, the transmission mechanism for what is developing in China into DM, into US credit, what is it?
Well, I actually think it's, overall, there will obviously be a transmission mechanism between China and the rest of the global economy. But I actually think it's less than maybe the markets in the short term were expecting, or maybe they were predicting when we saw this huge amount of volatility this week and last week as well. China continues to grow at a very decent pace. We know that they have the 6% GDP floor. We know even today we've seen the Politburo come out and be a little bit more dovish in terms of maybe reining back some of the language in terms of the clampdown in terms of regulation in certain sectors. We've seen that the PBOC is prepared to maybe loosen monetary policy a little bit as well in the short term. So I think that actually what we're seeing is China is really shifting, and it's continuing to really shift the economy into a sort of a longer term stable position.
Yeah.
And so while there will be a little bit of bleed into DM and probably more likely a bit more EM, it may have a bit more of an impact, for example, in the commodity producing companies and countries. But I think overall, I think it will actually be relatively muted.
Lisa Coleman, just quickly, your reaction.
Yeah, I agree with Marilyn. I mean, it's interesting. One of my colleagues who is based in China, manages equities, says, well, we get these disruptions every 3 years, so we're right on target. I mean, essentially what we think is happening is, we've got a government that's aiming for greater political and economic stability. I don't think they have any interest in disrupting the economy. Marilyn's absolutely right when she references the PBOC and their actions. We saw that with the RRR cut. So again, I think it's going to be relatively contained and don't really see a bleed out into the broader economy globally or into DM.
Ashish Shah, in 30 seconds, if you can, sir, final word.
I see two huge opportunities coming out of this. One, you can buy Chinese government bond ETFs and take advantage of the policy easing that China is inevitably going to be putting in to stabilize their economy. And on second, Asian high yield, you have the baby with the bathwater trade. You have yield developing in that market. You can buy, bonds with 10% yields that you will get paid back on.
Yeah.
And that's an opportunity in the marketplace that you can't find anywhere else. So
Ashish,
two huge opportunities.
In 30 seconds exactly, sir. Thank you. Alongside Lisa Coleman and Marilyn Watson. Appreciate your time, guys. Enjoy the weekend. From New York City, that does it for us. We'll see you next Friday. Same time, same place. This was Bloomberg Real Yield. This is Bloomberg TV.